Hello, Baker Investment students. It is Sunday, July 9th, 2023, so I hope everyone's been having a great weekend. We have 2 weeks left in the course, so just want to give you an overview of this week and just keep encouraging you to plug along. Main things for this week, you're going to read chapters 11 and 12. You're going to participate in your forum discussion. This will be the last forum discussion. Relative to the forum discussion, you get to see where everybody ends up. Thursday and Friday was kind of a rough day for the markets, especially with the economic data coming out, that inflation is still not under control. So that sent a signal to the Federal Reserve that we're going to keep having to raise interest rates, which, the job market is just really strong right now. So it's kind of defying some economic logic right now. But it looks like we're in for at least another rate hike or a couple more rate hikes until they get to the point where they feel comfortable that inflation is under control. But of course, this does mean, bad news for the stock market, bad news for bonds, which you're going to read about in chapter 11. But we'll see what happens this coming week. So with that, also, you'll have your homework. And the main, just remember the TaskStream assignment, you need to submit it to both Moodle and TaskStream. With the TaskStream assignment this week, you can look at a lot of different events that have happened in the past. There's the subprime crisis. There's the war with the Ukraine and Russia. There's general concerns about inflation. There was COVID, kind of a recent, we had as high as 10% unemployment, and the market really tanked during that time period, but it rebounded pretty quickly too. But when you're thinking about these, address the prompts. I kind of say with papers, it's best to kind of maybe do headers with these transitions to make it easier on yourself. But, again, you're kind of investigating the situation. With the subprime crisis, an example, the primary cause was the credit default swaps. It was a lot of these Wall Street firms and banks writing credit default swaps. It was basically an insurance policy that they could never really cover, and there wasn't a lot of good regulation in the market. So we kind of learned our lesson from the federal level and securities market level about making sure that you don't make promises that you can't keep in these markets. It was all betting on the idea that the home prices would never drop or fall. But when it did turn around, all these Wall Street firms are stuck like, oh my gosh, we wrote all these credit default swaps, we can't cover them. And then that's when the Federal Reserve and Ben Bernanke realized kind of the trickle effect and the systemic effect to our economy, because we were that close going to the next Great Depression. And that's where a lot of intervention was in place. So, but with that, do email me if you have any questions with that. So for the chapter readings, you're going to look at bonds this week, everything from yield to call, yield to maturity. You're going to look at the concept of duration, how it's calculated mathematically. Essentially, the lower the value of the duration, the less risk there is. Because you have to remember, like, if interest rates are going to keep going up and bonds are priced mark to market, even if you buy a bond for $1,000 and you hold it for that 20 years, you'll get your $1,000 back, but you have to price it as if you were to sell it today. And trust me, I've seen some of my bond fidelity funds just get hammered the past 3 or 4 years. I think the 10-year return is now about 2%. It's just sad. It's a good investment if you want it from a cash flow perspective. But yeah, it took some hits this week too. So, and with that, chapter 12, you're going to read a lot about the different mutual funds, the different types. And back in graduate school, when I went to UCM back in the early 90s, my finance professor said this to me, and I still believe this holds true today. Don't overthink it. Invest in the S&P 500 index fund. It has a low fee, and a lot of professionals have a hard time beating the S&P 500 index fund. So if you're given a lot of choices at work, I was helping one of my wife's friend this week, and she was received some money, and trying to get her to think about, the risk involved in just buying individual stocks. You're just kind of buying a whole strategy, better off to be in the S&P 500. It's averaged about 10% historically annually, and many professionals have a hard time beating that benchmark. So other than that, you're going to look at all kinds of different types of mutual funds, and then there's lots of choices out there. I mean, the number of mutual funds out there have exploded since I remember being in this business in the late 80s. You're going to look at the performance. You look at how net asset value is calculated. And you're going to even look at exchange. Okay. But there it seems to be back again. Sorry about that.
and you're going to pay a little bit of a premium on exchange-traded funds. So that's the big difference. It acts like a mutual fund, but it's more easily tradable. So, all right. Look forward to your last form discussion post. But again, if you have any questions, do email me. But otherwise, have a great week, and I'll talk to you online. Take care.